this new session, session 3 for the Agri commodity derivatives. Today we are going to start with another topic, uh, which is frameworks in commodity markets. So in the last lecture, we understood a few technicalities about futures, forwards, and options instruments. That gave you actually a quick recap of what you have already, covered up in your previous financial derivatives course. Now let's move towards dive deeper into the commodity market section. And once we, understand the frameworks properly, we will move towards, particularly towards only the agri commodity parts. Right. So since agri commodity is actually a subset of commodity overall, all the commodity markets, and so we will talk about, when we talk about the frameworks, we will talk about the frameworks which is common to all the commodities, not only the agri commodities. So when I'm talking about other commodity or all the commodities, it means it is applicable to agri commodities as well. Right. So today we'll be talking about the frameworks. What exactly are we going to talk about in the frameworks now? Uh, Yeah. So this is the session objective. By the end of this session, you will be able to explain the commodity exchanges and their role. What are different commodity exchanges and what are their roles, right? Explore the process of trading, clearing, and settlement. My most of the attention of this lecture will be towards point number 2, because commodity exchanges already have been covered up to a significant length in the first introductory lecture. In that, I have told you that what are the international and national commodity exchanges in agri commodities. I will be giving you a quick recap of that, and then after that, my most of my this focus will be on the process of trading. All these three processes, which is trading, clearing, and settlement. After that, we will be focusing on regulatory framework of the commodity markets as well. What are the different kinds of the participants in the commodity markets, how they operate, how what are the different other operations related to the trading, different types of the operations which are related to the trading or clearing and settlement in the commodity markets, will or in the exchanges, how to actually process the orders. I have also added those technical details in this lecture so that you can actually come to know when you actually start trading in the commodity markets. So there are many keywords, there are many technical terms you should be aware of. Okay, how to place an order, how to what is the margin money, what is mark to market, okay, how actually these things work in practical trading. So you will be at least acquainted with those fundamental technical terms, which you can later on use it for your trading purpose as well. Right. So these are the objectives of the session. Now, what are the outcomes? Now, in this session, you will learn about, as I already told you, you will be acquainted with the process of the trading, clearing, and settlement. And if you're acquainted with all these details, you are actually ready for your, at least you, when someone teaches you trading, live trading, right, in a workshop, so you won't be having any kind of confusions or doubts in understanding the language that you're using. Otherwise, you will feel that they are just speaking French to you, right? So next is you will be able to understand the role of the commodity exchanges, and you will be able to understand the regulatory framework of the commodity market. Okay, so before we start with, I would like to take you towards the evolution of the commodity markets, how exactly it started and how, what is its importance. Right now, commodity markets have undergone seismic changes over the past century. We used to have commodity markets since 17th century, but now they have undergone a lot of changes. Right, why? Because of the introduction of the technology, because of the introduction of different types of the processes, and incoming of the exchanges. Right, so dramatic increase in productivity have resulted in a declining trend in prices relative to the manufactured goods and services. So when we see the prices of the commodity, in which direction are they moving? So they are moving in the downwards direction in totality, because we have from the previous 2 3 centuries, we have actually improved our productivity, and there has been a declining trend in the prices. When we talk about, either we talk about the commodities or we talk about the manufactured goods and services, right? There have been innovations everywhere. You talk about the transportation, right? So transportation is a very key part which we need to focus. So when we say that I mean, when we talk about the commodity markets, any kind of markets you talk about, right? Storage and transportation. I mean, in total, we call it logistics. This is a very important part. And if a company actually can, make or break. A company can be made or become completely broken by the transportation charges or warehousing charges, because it is a significant portion of the total costing of the firm, right? So innovations in transportation have actually reduced the all over cost uh, of store of the commodities, because yeah, the final price of the commodity also reflects this transportation and storage cost, right? Now and also innovations in transportations have also given the traders the opportunities for the international trade in the commodities. Okay, so transportation industry has revolutionized this trading as well, because now you are not only limited to your local markets, but you actually can think about overseas markets. You can transport, you can store your goods in the or in the far-flung areas as well. So you are not limited to the local markets only. I mean, the sky is only the limit, and you can always get the best of the trade opportunities without thinking about the distance, right? Distance doesn't matter now. Okay, so the growing role of emerging market and developing economies, all these emerging markets coming up now, they are also being strengthened financially. They also have widened. I mean, initially, what was the problem was that even if you look at the scenario of 10 to 12 years back when I was doing my MBA, so in 2013, we used to study that if you talk about Indian stock, so India is a developing nation, right? And so so we used to study that if you in the Indian capital market or Indian stock markets, if you look at the ratio of the retail retail participation means retail investors. Okay, the people like you and me who buy very small amount of the shares. Otherwise, we have retail and we have wholesale, or we can say institutional investors in the markets. Okay, and institutional investors can be domestic or it can be the foreign institutional investors. And it was only 2% of the retail domestic retail investors in Indian stock market participation, if you look at only 2%. But we have come a far way from that time, and it has increased. But even now, you can see the kind of the turmoil which is happening, economic turmoil which we are surrounded by these days. The kind of the kind of the announcements which Trump is making about different types of the tariffs and taxes and for the imports and exports. So that those kind of announcements are actually affecting our foreign investments, foreign reserves, because the foreign institutional investors are actually taking away their investments from India whenever there is something US decides something against India. Okay, so yeah, I mean, this is the kind of the situation. So in emerging markets, mostly what happens in developing nations, the capital markets are not very deep. The number of the participants are not very high. You're dependent more on the institutional investors than the retail participation. And I always say to my students that when retail participants increases, the number of the retail participants, when they increase, it increases more democracy in the system, right? So yeah so it increases more democracy in the system. That's very important factor. And Yeah, yes, so that's why it is actually the kind of the shift in the emerging economies. Okay, the kind of the shift in the emerging economies, the kind of the development in the emerging economies, be it technology, be it finance, be it capital markets, or in the ease of doing business, all these things has also shifted the composition of the demand for the commodities, especially for the energy and metal. So all these developments in the emerging economies have led to what? Have led to actually there has been shift in the kind of the demand for all these commodities. What are these commodities? We have agri commodities, we have metals, we have energy. So when development, the pace of development has started increasing in these developing economies. What happened? Their demand. for these commodities will also increase, because if manufacturing, more of the manufacturing will take place in these nations, what will happen is that more requirement of these raw materials, or we can say all these commodities, will be there. So that's why we say that yeah, the composition of the demand of the commodities, especially for the energy and metals, have changed. For example, in China, earlier it was not before 1990s. It was not one of the major consumer of all these energy and metals, but now after that period, it actually became a hub for the manufacturing, and it became one of the largest consumer for the energy and the metals, right? So economic expansion after World War II, and more recently the emergence of the emerging markets and developing economies uh, as important players of the global economy. This actually thing has, after World War II, all this thing, that development of the emerging economies, this has led to the demand increase in the demand of the commodities, metals, and minerals, right? So even though the world population 1920, see, the world population was only 2 billion, and now in 2020, if we see, it is 8 billion. But yeah, we have actually matched up the pace of the production of the important commodities as well, be it cloth, food, or be it other things which are required to raise the population. We have actually done quite well on that part, right? So on the energy front, if you look at the one by one energy, metals, and other things, crude oil has become the most important commodity, replacing the coal. So earlier it was coal, but now, yeah, as with the advent of the technology and development of different types of the engines, the crude oil actually has become most important commodity, replacing the coal. The mineral resources development expanded because advances in technology and new discoveries, right? Reserves of the crude oil and natural gas have increased substantially. Even the production has risen, and mineral resources development expanded because of advances in. So yeah, it is technology which is helping all these either mineral resources, or we talk about the crude oil, the reserves of the crude oil. So all these things actually have increased because of the technology, right? When we talk about the metal production, right, that is also has been possible to for improvement, become more efficient due to the innovations and productivity improvements, right? There has been dozens of technologies which have actually come in the area of mining, smelting, and refining the metals, right? The major price fluctuations of the metals, right, perhaps, so that the of the other commodities have been mainly driven by the global demand shocks, such as the wars, Great Depression of 1930s, and rapid industrialization of China. As I told you, the rapid industrialization of China in 2000s actually led to a very, very sudden and increased demand of all these metals in China. And that actually another is one of the most important historical reasons for the major price fluctuations of the metal, because prices are actually the factors are determined by price, sorry, demand and supply. So demand and supply, so demand increases or supply increases suddenly, it will affect the prices considerably, right? So yeah, now coming to food, which is related to our agri commodities, right? What about the food? So the food production has increased faster than the population, and of the world's consumer have better access to adequate. So now food production also increased. There was a time when we were not able to. Different nations have actually different experiences. There are nations which actually could match the pace of the food production and the population later in the century, but yeah, all together we have been able to make it a balance between the kind of the demand which is required for the food production and the population requirement. Now, this improvement is due to technological advances in the 1900s, especially the Green Revolution. That's very much you're aware of, right? So, this is actually a brief history of how different types of the commodity markets evolved, and how what are the different factors which affected these commodity markets, which actually brought a revolution in these commodity markets. Okay, so now So commodity markets, what is commodity market? Already I have explained you in the introductory lecture, just giving you a repetition. A simple market where you trade commodities, right? What kind of commodities? We have metals, we have oil, all energy related. We have crude oil, natural gas, energy, and other spices, right? And spices and other agriculture commodities, among others. Okay, there is an array of different commodities. We have already discussed that. This is the commodity market. Now coming to commodity exchanges, because I will be talking more about the commodity exchanges in this lecture, and then the clearing and the settlement, trading, clearing and settlement processes, right? So in commodity exchange, what are commodity exchanges? Now these are the centers where the futures trade is organized in a wider sense. It is taken to include any organization marketplace where trade is routed through one mechanism, allowing effective competition among the buyers and among the sellers. Simply an exchange, a market basically, where this trading has been done. Particularly the futures trading is organized, and the buyers can easily contact the sellers. Its price discovery takes place, and the trade is actually completed, right? So they facilitate the trading process basically, right? They actually come as a middle person between the buyer and the seller, and takes the guarantee of the trade to be accomplished, decides the rules and regulations for the trade, and makes sure the trade takes place at the promised time, whatever is the time. We will talk about that later, but yeah. So they make sure this happens. Okay. So So commodity exchanges provide platforms to suit the varied requirement of the customers. As I told you, firstly, they help the price discovery as the players get to set the future prices, which are also made available to all the partner participants. Okay, so price discovery is one of the very important function of the these exchanges, because it's actually that all the traders, all the buyers, all the sellers are there on that platform, and they are actually trading over there, and the demand and supply is known to the exchanges, and based upon the kind of the demand and supply for a particular commodity, or a product which is based on commodity, for example a commodity derivative. Okay, so so they know the prices, right? So they help basically to discover the prices. Now hence a farmer, let's take this example, a farmer in the southern part of India would be able to know the best price, prevailing in the country, which would enable him or her to take the informed decision, right? So, yeah. So this is that's how it works. Secondly, these exchanges enable actual users, means farmer, agro processors, industry, with predominant cost is commonly input or output cost. Right now, these exchanges enable all these actual users to hedge their price risk, given the uncertainty of the future. Right, especially in agriculture, with the uncertainty regarding the monsoon, and hence the prices. Right, so a very good application, and the use of these exchanges, particularly for agri commodities, is that they actually help. This is one of the major function of these exchanges, that we can hedge our risk. What kind of risk? The price risk, right? Because there is uncertainty in the future about the prices of the commodities. So whatever commodity you are dealing with, if you want to make sure that your risk is covered up, your price risk is covered up, you will deal with these kind of the futures of forward product, the derivative products, the commodity derivative products, right? So in agriculture, this risk is actually more in comparison to the other commodities, because agriculture is not only dependent upon your efficiency being a farmer, it also depends upon the other external factors, government policies, and monsoon, majorly monsoon. So, I mean, it is very, very uncertain that what would be the output, what would be the prices. So, if you are a farmer, very, very old, applications of derivatives have been seen in the agri commodity markets only, right? They were actually started to hedge the risk of the farmers. initially, because they wanted to fix the price. They wanted to hedge the price risk. They wanted to fix the price at a future date before they cut their output from the farms. Standing crops used to be sold by the farmers to the industry people, so that they can actually safeguard themselves from the all the uncertainties of the future, right? So this holds good also for non-agro products like metals or energy products, as well as global forces could exert considerable influence. So purchasers are also assured of fixed price with which is determined in advance, thereby providing surprises to them. Right. So now purchasers will also be, given a chance to fixate everything, fixate the price. Thirdly, the commodity exchanges provide liquidity and buoyancy to the system by involving group of investors and speculators. So we have actually a system. Exchange is basically a kind of the place where we have actually collaborated all the different types of the participants. And since the number of participants are very huge over there, either seller or buyer or different types of the investors, right? That actually gives you a system of flexibility, a liquidity particularly, and you will not think twice before buying any kind of the financial instrument related to commodities from these commodity exchanges, because you are assured of the liquidity of that instrument, because there is a presence of the thousands and maybe more than that, thousands of the investors in that on that platform. So that's why you're not worried about that, and you know that you will find a seller whenever you will find a buyer whenever you want to sell this off in future. Okay, so this is the case with this. So now we will continue our discussion with the evolution of the commodity exchanges, right? So yeah, most of the commodity exchanges which exist today, they have their origin in 19th or 20th century. So I told you that commodity market is really an old market in the world, and it is 19th to late early 20th century. You will see that most of these exchanges had already, were taken their existence. Now, the first central exchange was established in 1848 in Chicago under the name of Chicago Board of Trade. So, this was the first exchange. The emergence of the derivative markets as effective risk management tools in 1970s and 1980s has resulted in the rapid creation of new commodity exchanges, right? So yeah, it was actually the derivative markets, the emergence of the derivative markets, which actually led to the rapid creation of all these commodity exchanges and the expansion of the existing ones. Because yeah, we needed these exchanges to run our derivative products. And yeah, people started thinking about hedging their risk in all these 1970s to 80s quite early in the period in the history, and that's how actually these commodity exchanges started mushrooming. Now, at present, there are major commodity exchanges all over the world, dealing with different types of the commodities. So we have different exchanges, and we have regulatory framework for all these exchanges, which actually help to set set up the rules and regulations to run these exchanges, and to make some standard procedures and guidelines for all the participants of these exchanges, right? So after independence, the parliament passed Forward Contracts Regulation Act in India, the 1952, which regulated the forward contracts commodities all over India. Right. So this act is a very important act in the history of India for commodity markets. And this particular act was for the forward contracts in commodities only. And in 1942, it was actually, came into the existence. Now, this act envisages three-tier regulations. What kind of regulations? Number one, the exchange, which organizes the forward trading in commodities, can regulate trading on a day-to-day basis. First of all, this thing that we have an exchange, we regulate the trading on a day-to-day basis. Number two, the Forward Markets Commission provides the regulatory oversight. We will talk about the Forward Market Commission and its importance in the upcoming slides. But yeah, it is a very important central regulatory body when it comes to the forward market, the commodity markets, the forward markets in commodity area. And so this provides the regulatory oversight under the powers delegated to it by the central government. The central government Department of Consumer Affairs, Ministry of Consumer Affairs, Food and Public Distribution is the ultimate regulatory authority. So these three is a three-tier regulation done by exchanges. Number one, number two, the Foreign Market Commission, and number three, the central government, particularly the Department of the Consumer Affairs under the Ministry of Consumer Affairs, Food and Public Distribution. So all these three nodal agencies helps to regulate the commodity markets in India. Okay. Now the Forward Market Commission of India. Let's understand what is Forward Market Commission of India. So this is the regulatory body for the commodity markets in India, right? The forward contracts uh, in the forward contracts in commodities are regulated as per the foreign contracts, futures contract. Yeah, the Forward Contract Regulations Act 1952. This is the short form for Forward Contract Regulations Act 1952, right? So now the inherent objective is to achieve price stability by means of price discovery and the risk management. Okay, so we want price stability in the commodities market, and we want the price discovery. We want it to be a stable kind of the market where risk prices do not fluctuate too much, because it becomes difficult for the traders if the prices are not brought about under the control. And we do not do any kind of the artificial procedures to bring the prices under control, but the exchanges regulate the markets in such a way that the prices come under control. Now the commission also collects information regarding the trading condition in respect of goods to which any of the provision act is made available, right? So it keeps a actually very good check on all the types of the conditions and all the happenings in the market, like SEBI does in the case of capital markets in India, right? So SEBI is a kind of the police when it comes to capital markets, and it keeps on checking even the small, ups and downs of the market, and make sure that the market is not influenced under any kind of negative this thing. So there is, I mean, we can just imagine the kind of the dedication of SEBI towards regulating the market properly, from the fact that there has been inquiry on the I mean, even the director of the SEBI is not been given any kind of the privilege or any kind of the flexibility when it comes to malpractices, and the case has been going against the director, ex-director of the SEBI itself, right? So, whatever position you are at, but you are being scrutinized very tightly by SEBI, and in the same way, Forward Markets Commission of India is doing the same for the forward markets, right? So, commodity exchanges in India, now there are more than 20 recognized commodity futures exchanges in India under the purview of the Forward Market Commission. Now, there are two categories: national exchanges and regional exchanges, right? So, I will be telling, just giving you a hint of national exchanges. Other regional exchanges have already been covered up in the first lecture. You can just go and have a look over the kind of the regional exchanges over there. Now, the National Commodity and Derivative Exchange of India, NCDEX, National Multi Commodity Exchange of India Limited, NMCE, Multi Commodity Exchange of India Limited, MCX, India Commodity Exchange Limited, Ace Derivatives and Commodity Exchange Limited, Universal Commodity Exchange Limited are the few national level commodity exchanges operating in India. And now let's move towards the trading process in the commodity market. Okay, how the trading takes place. What are the important terms which are related to trading? As I told you, I will be telling you some keywords about the important jargons and important concepts in the trading in commodity markets in this lecture, and that definitely will equip you for the practical trading sessions you need to undergo if you are interested, if you are actually interested to go for an actual live trading in the uh, commodity market, right? So important terms and its explanations. Number one, we have margin money. Okay, so margin money is a security deposit given by the trading members to the exchange in order to deal in different contracts listed over there. Okay, so what happens is that you have to, before the start of the trade, you have to deposit some money as a kind of the security. It is a kind of security deposit, so you have to give this if you want to deal with the different type of the contracts. The clients deposit this money with the member, who in turn transfer it to the respective exchanges. Okay, so we are the clients who actually want to deal, and we do it, the trading members who are actually the kind of the people working in the trading houses, and then it can transfer it to the respective exchanges. It is further transferred to the respective exchanges through a trading member. Okay, so the aim of the margin money is to minimize the risk of default by either counterparty, right? So, yeah, the risk of the default is minimized because you have actually given some kind of the financial security, and that's because there are many types of the derivative products in the commodity markets where the counterparty may actually say no to the uh, trade, may actually default in many cases, and the other party will have to bear the loss. So that's why we have the margin money concept, where this security deposit helps the exchanges to make sure that the other party will not default. Okay. Now, in futures trading, the entire value of a contract need not to be paid. The margin is typically between 2 to 10% of the total contract value. You don't have to pay the whole amount in advance, right? And the 10% of the total value of the contract need to be paid while entering into the contract, and the rest can be like a margin money. It is only 2 to 10%. The rest can be paid later on. It is the part of the risk management system as prescribed by the market regulator, Forward Market Commission, right? So yes, this is a risk management system because it helps the partners save the partners from the default. Okay. So different types of the margins payable on the future. So we have in total five types of margins. It is not only one type of margin. We have ordinary or initial margin. We have mark to market margin. We have special margin, volatility margin, and we have delivery margin. Okay. So number one, let's start one by one and understand all these types of the margins. The initial or ordinary margin. It is the amount required to be deposited by the market participant in his margin account with the clearing house before they can place in order to buy the sell the futures contracts. Okay. This must be maintained throughout the time their position is opened and returnable at the delivery or expire or the closing out of. So once if your position is open, this particular amount has to be maintained by you being a trader, and once you're closing out, it can be returned back to you, right? It is refundable. Then when a futures trader enters into future position, he or she is required to post initial margin, right? So you when enter into a future position, you are required to post an initial margin of an amount specified by exchange or clearing organization. Therefore, the margin becomes mark to market and the margin account. So we will learn about that. What happens is that when you actually enter into a future position, then you are required to maintain some initial amount, which is known as the initial or ordinary margin. Later on, your margin becomes mark to market and the margin account will be adjusted automatically, right? Later on. What is mark to market? We'll come to know now as the next type of the margin is mark to market only. At the end of client trading day, the margin account of the trader or client is adjusted to reflect the participant's gain or loss. Right. So yes, it is actually what happens is that when you take the position in any kind of the trade at the starting, the prices of the commodities are somewhat else, and later on the prices keep on changing. So at the end of every trading day, you will actually gain either gain or loss. Right. Now, this has to be reflected in your account. The price changes on the close of every trading day may result in some gain or loss as compared to the previous day's closing price. Okay. So these price variations are netted to the daily margin account, and this process is known as marking to the market, right? So now when these price variations are actually balanced out on a daily basis, that whether are you at the end of the day you have not basically closed your position, you're still there, you have taken your position, but still on a daily basis you will come to know, you can just like stock, your stock market account, on a daily basis, whenever you open your demat account, they will show you that whether on a net basis you are on a profit, that's called the unrealized profit or unrealized loss, right? Whether you are on a profitable position or you are on a loss making kind of position, that's called the marking to the market. Okay. Now, mark to market margins are payable based on closing prices at the end of each trading day. So what happens that if the price declines, it will be paid by the buyer at the end of the day, and if the price increases, it will be paid by the seller. So every in this case, every day they will be checking it that who out of buyer and seller is at a gain position and who is at the loss position, and the one at the loss position will make payment to the one at the gain position, right, according to the fluctuation of the prices. Okay. So this is different, this is something different than the normal shares trading in the commodity exchange markets. So the margin is worked out on difference between the closing or clearing rate and the rate of the contract, if it is entered into that day, or the previous day's clearing rate. The exchange collects these margins from the buyers if the prices decline and pays it to the seller. So they don't pay it to each other. Basically, it's the exchange which collects these mark to market margins on a daily basis from either buyer or seller based upon the fluctuation of the price and makes this payment to the other party. Okay. Now, third one is the special margin, or we can say additional margin. So it is the additional margin imposed by the exchange to curb excess volatility in the market. Okay. It varies from commodity to commodity, and the purpose is only to absorb the excess of the volatility in the market. Number four is the maintenance margin, right? It is the minimum level at which equity in futures account must be maintained. If equity in an account falls below this level, a margin call will be issued and the funds must be added to the bring the account back to the initial margin level. So yeah, you have to maintain a minimum margin level, which is this one, and the maintenance margin level generally is normally 75% of the initial margin requirement, right? So initial margin is how much? 2 to 10% of the total contract value, and out of that small amount, 75% of that has to be minimum. If you actually fall below this thing, then again a margin call will be issued to you, and so that you can actually add funds and bring your account back to the initial margin level. So this is all just to risk mitigation strategies. All these margins are maintained because of that, because later on every day your position changes and the amount has to be transferred from your account to the other account or vice versa. So that's why you need actually some kind of the minimum margin in your account. So if the amount of the money in the margin account falls below the specified maintenance margin, the futures trader will be required to post additional variation margin to bring the account. So yeah, you will have to maintain it to the initial margin level again. So how much amount we will add now? So you first of all put some money in your margin account, which is the initial margin, right? Now let's suppose that is 100 rupees initial margin, and your this maintenance margin is, let's say it is 30 rupees. Okay, so on a daily basis the mark to market settlement keeps on taking place and the account keeps on reducing from your account, and now your account has reached where it is 25 rupees now, right? So how much money will have to be put again, because it is less than 30 na? A margin call will be issued on your name. How much amount do you need to put back to your account? It is how much to make it equal to uh, how much it was initial margin? 100, right? So you will have to put around 75 rupees to bring back it to initial margin of 100 rupees, and then again it will be back on the initial margin level, and if the futures position is profitable, the profits will be added to the margin account, right? Yeah, so though all those profits will also be account for it. Now, next is delivery period margin. It is the extra margin imposed by the exchange on the contracts when it enters the concluding phase, starts with tender period, right? This amount is applicable on both the outstanding buy and sell positions, right? So this was about the types of the margins. Now we will do this order types. Just have a look. Now let's talk about another topic. After you have the knowledge of different types of the margins and how they work, now let's talk about the different types of the orders, right? So now there are different ways in which you can actually put up your orders. An electronic trading system allows trading members to enter orders with various conditions attached to them as per the requirements. So in the stock market as well, you have your demat accounts, and the trading system allows you to put different types of the orders. There are some orders with the stop loss. There are some orders which will be executed at the exactly same time when you enter them. Other orders are time orders, right? They give time conditions that particular after particular time period they must be executed, or you put some conditions on them. Then when you will get this particular price, then only the order should be executed, otherwise not. So if you get this kind of the buying price or selling price, now, these conditions, in case of commodity markets also, the exchange gives you different types of the orders. Okay, so these conditions are broadly divided, which are attached to the order types. These conditions are broadly divided into following category. Number one is the time condition, price condition, and other condition. Okay, so time condition, good till day order. GTO we say, order that, as its name suggests, is order which is valid for only one day. You put that order, if in the 1 day period your condition is matched, it will be entered, otherwise it won't wait longer, right? If the order is not executed during the day, because maybe the condition is not met, you didn't get the required amount of price that you were actually willing to sell or buy your commodity on, then the system cancels the order automatically at the end of the day, right? Then good till cancelled. GTC. GTC order remains in the system until the user cancels it, opposite to the GTO, right? So it spans the trading days if not traded on the day or the order is entered. It keeps on, it sits in the system and waits for the condition for which it is waiting of, and if it is met, the order will be executed. Otherwise, it will only be cancelled when the user, him or herself, cancelled it. Good till date. Well, GTD. Well, this type of the order allows the user to specify the date till which the order should remain in the system if not executed. So here it is actually giving you both the benefits. It is waiting for that condition to be met which you want, let's say a price condition, and it will not be there for infinite time in the system, because sometimes you might forget also to cancel that. And but you know what that you don't want it to be there infinitely long period of time, because market conditions keep on changing. And then let's suppose market condition change, and your condition for executing that order was a particular price, but in the market the price, if you put it like, if you put it as a good till cancel order, but yeah, after let's say a month, the market conditions are different, and actually there are buyers who are willing to pay more price than what you set in that order. In that situation, you will be at a loss. Okay, so what did you do? You actually put up a date that after this, the order will be cancelled automatically. You set a larger window of time for that order to be executed, right? So immediate or cancel, IOC, right? Fill or kill order, we also call it. An IOC order allows the user to buy or sell contract as soon as the order is released into the system, and if it cannot be done like that, it will be cancelled. So if immediately it finds someone, I want this to buy some contract, I want this contract to be implemented at a particular price, and if it is not done immediately, then it will be cancelled. Okay, so that thing is known as the immediate or cancel order. So a partial match is possible for the order, and the unmatched position of the order is cancelled immediately. Now, next, the category of order is the price condition. The first was the types of the orders were classified based upon the time condition, and now we have the orders classified on the basis of the price condition. So limit order, right? An order to buy or sell stated amount of commodity at a specified price, right? Or at a better price if obtainable at the time of execution, right? So, uh, yeah. So this is known as a limit order. You put a limit to that, and if you can get something between that limit, right, or a better price also, then it will be executed. Stop loss order. You want to minimize your loss, so that's why you put a stop loss order, right? It is placed with the broker. A stop loss order is an order placed with the broker to buy or sell a particular, futures contract at the market price if and when the price reaches specified level. Further, futures traders often use stop loss order in an effort to limit the amount they might lose if the future price moves against their position. So yeah, in futures contract, there is a chance that you actually can go for quite a significant amount of loss. And for example, what happens is that for example, this price fluctuation is not in your favor. You entered into a long position, and that you will buy so and so commodity at so and so date at so and so price. But if the market price is actually coming very low, you are entering into a spiral of infinite loss. What happens is that if in that condition, your this you can actually put a stop loss order where you can put a limit to the loss, and your loss will be limited to that level, beyond which if it falls beyond that level, you won't be actually have to face any kind of the loss, right? So these were the two types of the orders based upon the price condition. Then we have other conditions: market price, trigger price, and spread order. What is market price? Market orders are the orders for which no price is specified at the time of the order, at the time the order is entered, right? So yeah, so there is no price being specified by the user. By default, the market price, which is right now going on in the market, is being picked up, and the order is executed on the same. And this executes quite fast because you don't have any kind of the condition put up on the price. Trigger price, the price at which an order gets triggered from the stop loss book. And last one is spread order. A simple spread order involves two positions. One is long and one is short. They are taken in the same commodity with different months, right? Or in closely related commodities. Now, let's after that we have actually gathered knowledge about the different types of the orders. Now let's move towards the different electronic spot exchanges. Okay, so what are the different electronic spot exchanges? We were talking about the future exchanges. Now we talk about the spot exchanges. So electronic spot exchange is also an emerging phenomena. I mean, these spot exchanges provide real-time, online, transparent, and vibrant spot platform quality. So these electronic exchanges are not only required in the future market, but they are equally required in the spot markets as well, right? These contracts, the contracts allow participants from all over the country to buy and sell, thereby enabling producers and users to discover the best price. So you actually can collect all the participants, buyers and sellers under one electronic spot exchange. And even they want the spot trades to take place, they won't have to find each other. I mean, the price discovery, convenience, and trades happening in a regulated kind of the environment. All these are the benefits of having the electronic spot exchanges. Now, the government has allowed the national commodity exchanges to set up three spot exchanges in the country in India. Now, one, National Spot Exchange Limited, NSEL. Number two, NSDEX Spot Exchange Limited, NSPOT. And number three, we have National Agriculture Produce Marketing Company of India Limited, NAPMC. Right. So these are the three spot exchanges in the country. So during 2009, there was a significant expansion of the spot exchanges trading facilities in India. These spot exchanges have created an avenue for direct market linkage among the farmers. It's a very good thing that in an important point that they have created a very good market link between all these participants, between the farmers, processors, exporters, and end users. Right? It helps to reduce the intermediation cost and enhance the price realization by the farmers. So they have just one electronic place, and you know what, there are electronic spot exchanges or electronic spot markets in many commodities at the local level as well, right? For example, when we talk about people who are into manufacturing business, they let's say that they want to buy steel on a regular basis, right? So what happens, I mean, how they come to know about the rates and the different types of the sellers which provide that. So they have access to, at a local level also, they have created different types of what do we say, electronic exchanges, electronic platforms. Just have to check that platform and see that how this thing, they have to check and just look at the daily prices which are being updated on those exchanges. And these spot exchanges have created, they actually have helped to link all these different participants. And it also reduces the cost of intermediation. So be it agri commodity products or metal products or any other kind of the products. For example, in the textile industry as well, there are certain manufacturers who actually have access to such electronic exchanges where the price of the thread is updated on a daily basis. So price of thread is a determinant of all the other prices, right? When we move downwards the supply chain. And that's actually another example of having spot exchanges, electronic exchanges. So they will also provide the most efficient spot prices inputs to the future exchanges, price discovery, as I told you. On the agricultural side, the exchanges would enable the farmers to trade seamlessly on the platform by providing real-time access to price information and a simplified delivery process, thereby ensuring the best possible price, right? Now, on the buy side, so what happens on the sell? Yeah, so basically, on this agriculture side means on the sell side, on the selling side. And uh, uh, exchanges, yeah. So farmers get an access to the very easy trade facility because now they have a real-time access to the price information. So yeah, real-time price information is the main key of whole story. Everybody wants an access to the real-time. What's the real-time price going on? What's the current price going on? And they want an update on a real-time basis on the price of the particular commodity in which they are dealing, right? So it gives a real-time access to the price information and that actually on the sell side the farmers are really very much facilitated by that. When we look at the buyer side, who are the buyers in the agri commodity market? It can be different people in the value chain. For example, all the users, I mean, either it can be a manufacturer or later on a retailer, anybody. So all the users of the commodities in the commodity value chain would have simultaneous access to the exchanges and will be able to uh, procure at the best possible price. I mean, having an access to the best possible knowledge about the best possible price is important for them as well. So that's why they will be able to procure their goods at a best possible price. The National Commodity and Derivative Exchange Limited has set up electronic spot market, yeah, electronic spot exchange called NSDE Export Exchange Limited. Now, after having this knowledge about all these different electronic spot exchanges, all the different types of the, order types and all the different types of the margin, money margin accounts, now we are well equipped to take on the next topic about clearing and settlement. See, all these things that we have done in I just spoke about, all these things are related to what? It is related to trading, right? So trading part is done. We know now the basics of trading. Now let's move towards further upcoming steps after trading. We need to understand the step which happens at the background. Okay, clearing and settlement. We only look at the exchange. We only look at the electronic exchange platform which is being provided to us for trading purpose, and we see that how it works. We put up the order gets executed. But what happens in the background? How actually the order is executed, that all depends upon the clearing and the settlement. Most futures contracts don't lead to the actual physical delivery of the underlying asset, right? So these are basically done on a cash settlement basis. Most of the future contracts today, nobody wants the actual delivery of the commodity. People only do this to take the position and earn the profit out of that, right? So the settlement is done by closing out or opening the positions, physical delivery or cash settlement. Mostly on the cash settlement it happens. So on a net mark to market basis, daily they see what is the position, and when the contract is reaches its maturity, whatever is your final position, you actually close on that position, and the finally all the profits and losses will be actually realized in your account, right? So all these settlement functions are taken care of by an entity called the clearing house. Now we say all these things that yeah, the position opens, the position closes, the settlement takes place, but who takes care of all this? It is actually the clearing house, or we can say clearing corporation, right? So clearing, what exactly is clearing and what is clearing house? So clearing of the trades that takes place on exchange happens through the the exchange clearing house. Clearing is basically all that process which happens at the background of settlement, right? The settlement and the final implementation at the back which happens. Now this actually is done through clearing exchange clearing house. I mean the clearing house of the exchange. And what is a clearing house? A clearing house is a system by which exchange guarantee the faithful compliance of trade commitments undertaken on the trading floor or electronically over the electronic trading system. Right. So it means that with the exchange, it is actually something which is related to exchange. Exchange has a clearing house, and based on the clearing house actually enables the exchange to guarantee the faithful compliance of all the trade commitments undertaken on the trading floor. So whatever commitments were actually undertaken on the trading platform, to make sure that exchange is able to do that, it is clearing house which enables the exchange to fulfill all these commitments. The main task of clearing house is to keep track of all the transactions, okay, that take place during a day, so that the net positions of each of its members can be calculated. So keeping a track of all the transactions and making sure the net positions of all the members are calculated accurately, and further steps can be taken, can take place. That's called actually the primary function of the clearing house. It guarantees the performance of the parties to each transaction. Performance of the parties to each transaction. Okay, so yeah, each party will perform according to the commitments that they have made in this particular trade. Both the parties will perform accordingly. It is the clearing house which takes the guarantee, right? So clearing house is responsible for what? These are the following things which for which clearing house is responsible. Number one, effecting the timely settlement, whatever according to the order type which has been executed, effecting the timely settlement. Number two, trade registration and follow up. Number three, control of open interest. Number four, financial clearing of the payment flow. Number five, physical settlement by delivery or financial settlement by a price difference of the contract. Whatever is the delivery type, either physical or delivery by the cash, they take that. They actually implement that. These are the main functions of the clearing house. So the clearinghouse has a number of the members who are responsible for clearing and settlement of the commodities traded on the exchange. Obviously, they have a lot of members. The margin accounts for the clearinghouse members are adjusted for gains and losses at the end of each day. In the same way, the individual traders keep the margin accounts of the broker. Every day, the account balance of each contract must be maintained at an amount equal to the original margin times the number of the contracts outstanding. Important thing, every day their account balance for each contract has to be maintained, right, by this particular amount. So thus depending on the day's transactions and the price movements, right, the members of the trade members will either have to add some amount in their account, or can withdraw some funds, right? Whatever is the position, whatever is the net profit or loss, they can either add funds or can withdraw the funds from their margin accounts, whatever is the profit or loss at the end of the day, right? So the brokers who are not clearing members need to maintain a margin account with the clearing house members through whom they trade. So that's again an important part, right? So which helps whatever all the conditions we have discussed in the margin account, all these things are basically at the back end implemented by these trading members of the clearing house. Yeah. So now, yes. Yeah. So, clearing mechanism. Let's move towards this clearing mechanism now. So, only clearing members, including the professional clearing members, are entitled to clear and settle the contracts through the clearing house, right? The clearing mechanism essentially. So, these are just the processes you have to go through once, and you just read them once, and you will be able to understand them properly, right? The clearing mechanism essentially involves working out open positions and obligations of the clearing members. The position is considered for exposure and daily margin purposes. The open position of these professional clearing members, right? They have to take these positions, and the open position of the professional clearing members are arrived at by aggregating the open position of all the trading members clearing through him. So every professional clearing member will be given certain trading members, right? So certain a bunch of the trading members will be trading under this particular clearing professional clearing member, and the position of on a daily basis, on a daily margin basis, the position will be considered. The open position of this professional clearing member will be arrived at aggregating the opposite, all the trading members who are actually trading under this PCM. We will aggregate the positions, all of them, of all these members, and then after that, we will be clearing it through him in contracts which they have traded, right? So a trading come clearing members open position is arrived at by the summation of the client's open position in the contracts in which they have traded. Right. So the client positions are netted at the level of the individual client and grossed across all the clients at the member level without any set-offs between the clients, right? It's getting a little bit of theoretical. This part is little more theoretical, but we have to go through because we can't skip the regulations part. But yeah, this is pure theory, so a little monotony may be felt. Even I can sense that. But yeah, I mean, you need to go through them just yourself. I will just give you this material. Plus, I will also give you a very good book, a part of that book which talks about these regulations in detail. You can go through the examples given in that book also, and you will be able to understand it in a in-depth manner once you go through it, read it yourself. Right. So, yeah. So proprietary positions are netted at member level without any setups between client and proprietary positions. After the trading hours on the expiry date, based on the available information, the matching for the deliveries take place firstly on the basis of locations and then randomly keeping in view the factors such as available capacity, vault or warehouses, commodities already deposited and dematerialized and offered for delivery, etc. Right. So at the end of the trading hours, all these positions are closed, and the matching of the deliveries takes place, and all the things are done at the back end, right? How matching is done? Matching is done by this process is binding on the clearing members. That's very important. After completion of the matching process, clearing members are informed of the deliverable or receivable positions and unmatched positions. There will be some positions will be matched, other positions will be unmatched, and the order may be cancelled also. So all they have to be settled in cash. The cash settlement is only for the incremental gain loss as detrimental on the basis of the final settlement, right? So now we take 5 to 7 minutes of break, and then after that, we will be back on this clearing banks, and then we complete our topic, right? Yeah, so let's meet after a small break. Yeah, so let's continue the topic. Yeah. Now, after that, we have gone through briefly through the clearing process. Let's move towards understanding the details of one important entity in the process of clearing, which is clearing banks. So, commodity exchange has designated clearing banks through whom funds are to be paid or received must be settled. So, just like the capital markets, just like the stock exchanges that we have, they also have the clearing banks at the back end for this transfer of the funding. We in commodity exchanges as well, we have these clearing banks through whom the funds are actually paid or received. Wherever there is a settlement of any kind of the trade, it is these clearing banks through whom the funds are actually exchanged, right? So every clearing member is required to maintain and operate a clearing account. Obviously, if they don't have an account with these clearing banks, the transactions cannot be fulfilled. So every clearing member needs to have an account with them, and with any one of the designated clearing bank branches. So they have different branches. Any one of the designated branch, they can open their account, right? So the clearing account is to be used exclusively for clearing operations. Um, Yes, so the clearing account is to be used exclusively for clearing operations, that is for settling the funds and other obligations to commodity exchanges, including payments of the margins and penal charges. So you know that what kind of operations are there in the clearing process, right? There is a you have to make the payments for the margins. There are other penal charges sometimes, according to the situation, which are being charged to the members. So all these funds settlement function has to be performed by these clearing banks, and clearing members need to have a clearing account or with these members, right? So a clearing member having funds obligation to pay is required to have a clear balance in his clearing account on or before the stipulated pay in day or and the stipulated time. Clearing members must authorize their clearing bank to assess their clearing account for debiting and crediting their accounts as per the instructions of the commodity exchange. Reporting of balances and other operations may be required by the commodity exchange time to time. So it is the commodity exchange which actually acts as one regulator, right, to actually make sure that all these members are working with each other, and they are actually, reporting all these balances are being reported by the clearing members, and the funds, adequate amount of the funds are maintained in their accounts, so that the final settlement actually cannot be delayed. Right. So the clearing bank will debit or credit the clearing account of clearing members as per the instructions received from the commodity exchange. Okay, so it will be the commodity exchange who will be having the final authority of telling these clearing banks that what particular action they have to take, debit or credit of which particular member. So who will actually tell them? So clearing banks are not going to assess it on their own. They will be actually receiving a instruction from the commodity exchange. Now, depository participants. So every clearing member is required to maintain and operate two clearing member pool account, each at NSDL and CDSL. So these are the two clearing. We have clearing houses, depositories basically, not clearing houses. We have two depositories which actually takes care for all the different types of transactions in the capital market, be it the stock exchanges, be it for the commodity exchanges. So we have NSDL and CDSL, right? So, so every clearing member is required to maintain and operate two clearing member pool accounts. So every clearing member needs to have accounts each at NSDL and CDSL through any one of the panel depository participants. We have DPs, depository participants. If you want to access, if you want to have an account with any of these depositories, we won't be having a direct access to these. We will be reaching them through our depository participants. These are number of the different brokers that we have. They help us. For example, we have 5paisa, we have Zerodha, we have Share Khan. So all these depository participants helps to actually, open your account at these depositories. You don't open it directly. So the clearing member pool account is to be used. Now, this is a different special account that they have. Clearing members of the commodity exchanges that have is clearing member pool account. So this is to be used only for the clearing operations, right? For effecting and receiving the deliveries from the commodity exchange. Then after that, the clearing process has been completed. Now let's move towards the settlement process. This is the last process in the order, and this process says that a settlement involves payments, pay-ins, and receipts, payouts for all the transactions done by the members. Now, trades are settled through exchanges settlement system, right? So this is the final step, and it involves the final payments and the final receipts of for all the transactions. Everything has been calculated at the back end, cleared from the back end, and now comes the time when they have to finally make the payment. So future contracts have two types of settlements, the mark to market settlement, which happens on a continuous basis and at the end of each day, and the final settlement, which happens on the last trading day of the futures contract. This is an interesting one, right? So we have both the types of settlement, one which happens daily, whatever price fluctuations actually happened, right? According to those price fluctuations, your position was different at the start of the day and at the end of the day, right? Your position is different when you started entered into the trade and now, right? Every day, every minute it changes, and so at the end of the day, at the end of the every trading day, this position is changed, and this that is called the mark to market settlement, when your final this you are netted on a daily basis according to the price fluctuations. Okay, so for instance, NCDEX, which is an exchange, commodity exchange in India, daily MTM settlement and final MTM settlement in respect on the yeah. So we have both daily and final MTM settlement in respect of the admitted deals in the futures contract are cash settled by uh, debiting or crediting the clearing house, right? So we will do an example which will actually help us to explain this process more clearly. But yeah, in this particular case, they have given an example where this particular commodity exchange has actually both these kind of the settlements. All the positions of a commodity member either brought forward, created during the day, or closed out during the day are marked to market on at the daily settlement price or the final settlement price at the close trading hours on a day. Right. So, what is the daily settlement price? What is the final settlement price? And what is the settlement mechanism? We will go through this. This will be the last part of our lecture for this particular settlement. Right. So, the daily settlement price is a consensus closing price as arrived after closing session of the relevant futures contract of the trading day. However, in the absence of trading for a contract, during the closing session, daily settlement price is computed as per the method described by the exchange from time to time. So, particularly in nutshell, the first line explains this meaning quite clearly that it is actually the closing price as the right after closing sessions. When the session is closed, so based upon a consensus, they come to a final closing price at the end of the day, and that's called the daily settlement price. After that final settlement price is the plotted spot price of the underlying commodity in the spot market for the last trading day of the futures contract. So whatever contract you have entered into, a future contract that will be having a maturity. Now at the end of, we are not talking about the daily settlement prices or daily price. We are talking about the final price, where final means that at the maturity of the future uh, contract. Okay, all the open positions in a future contract cease to exist after its expiration date. So at the maturity of the futures contract, whatever is the price, that is called the final settlement price. And then after that, all the open positions in the future contract will cease to exist. It will be closed after the expiry day has come, and it will be finally settled, it will be finally netted, and the whatever is the balance amount will be transferred from either buyer to seller or seller to buyer, whosoever is at the profitable position. That's called the final settlement price. Now after we do that, what are these settlement prices? Now let's have a look at the settlement mechanism. How does the settlement actually take place? That's an interesting part. So settlement of commodity future contracts is a little different from the settlement of the financial futures. Now you have done those financial derivatives, right? And most of financial futures are always, settled on a cash basis. But over here we have a settlement mechanism which is which offers these contracts to be settled on a physical basis also. A physical settlement can also be done in the case of the commodity futures, and which is more complicated, right? So at the end of this slideshow, I will also take you towards the details of the kind of the physical settlement. When physical settlement takes place, what are the kind of the things we need to focus on? What are the kinds of things which affect the settlement of a physically settlement of a contract? That's actually one important part, right? So in this we have daily mark to market settlement, and yeah, so first of all, let's move towards this example of daily market settlement. Right now, as we have already done it quite a number of times, that what happens is on a daily basis, right? Daily mark to market settlement is done till the date of the contract expiry comes. We keep on looking at the end of each trading day. What is my what is my net profit or loss for the day according to the price fluctuation of the commodity, right? So why do we do this? This is done to take care of price fluctuations for all the trades. Now, all the open positions of the members are marked to market at the end of the day, and profit or loss is determined as below. Let's see how. On the day of entering into the contract, it is the difference between the entry value and daily settlement price for that day. Right. So let's suppose that let's directly come to this example. The following explains the mark to market for a member who buys a 1 unit of December expiration chili contract at rupees 6 or dollar 6435 per quintal. So these are the dollar values, right? 6435 per quintal. The expiry is there in on December 15th. Yeah. So there is a chili contract which expires on 15th of December. No, it actually starts at 15th of December, and this is the value 6435 per quintal, right? 1 unit of December expiration chili contract. It expires also in December only, but the contract starts at December, and it expires at a value which is 6435. Okay, now see that on December, what is the settlement? See, we will just calculate the difference between this price, which is called the settlement price, 36320 and 6435, right? So what I'm checking on, see, we have this settlement price, right? Yeah. On the day of entering into contract, it is the difference between the entry value and the daily settlement price for that day. Right. So what is the daily settlement price for that day is 6320. When we look at this value of 6435 and 6320, we find the difference to be 115. Right. So yeah, you bought this contract at, see, this is the difference between the entry value. You bought this contract at 6435 per quintal, right? This was actually not your expiration value. This is actually your entry value. Okay, so you entered this contract at 6435, and the first very day, this the final settlement price of this contract was 6320. You take the difference out of that, and that's your mark to market. You are actually into loss of 115 rupees. Next day, what happened? The final settlement price was 6250. Then you do what? The MTM profit or loss per unit of trading show that the member makes a total loss of 120 per quintal of the trading. So upon closing his position, yeah. So when we see the next day, it was 6250, right? And when we look out the difference between 6250, yes. Now what we see? when we started this, we took the difference between the settlement price of that day and the initial price, right? Now, when we at the end of the second day, when we look at the settlement price is 6250, I am going to check with the previous day settlement price, and the difference is 70. Again, I am at a loss, right? So because it is falling regularly. Again, now in the next time it is 6312. I look at the difference between 6250 and 6312, and now I am at a gain of 62. So I keep on checking these differences, and I keep on checking my mark to market, daily mark to market value, right? This is how I actually come to know between about my this. So the unit of trading is 5 MT, and each contract is delivered at 5 MT. The member closes position on December 19. The position is closed. The M2M profit or loss per of the trading show that the trading member makes a total of 120 per quintal of trading, right? This is the total profit out of the this settlement of 120 $120 per quintal of the trading, right? So and this settlement is done on a T plus 1 basis, not T plus 2 unlike the stock markets. Upon closing his position, he makes a total loss of 6,000, that is 5 into 120, sorry, 120 is the loss actually. So 5 into 120 into 10, that makes it 6,000, and this is the total loss of this person out of this position. So when you look at all these values and you actually make a total out of that, what value do you come is the you get actually the loss minus 120, right? So you see, if you can calculate it, this is minus 115. Sorry. Yeah, so let's take the positive values first. 62 plus 5. Then we take the negative values minus 115, minus 70, and minus 2. And it comes out to be, I just added all these MTM values and it comes out to be minus 120. Okay, so 120 per quintal is the loss. And after that, we calculated the total loss, which is 6,000, right? So this is actually the way we, calculate these things, calculate the MTM on a daily basis and calculate the total loss or the total profit of these commodities. And on the date of expiry, the final settlement of the closing price of the underlying commodity in the spot market on the date of expiry of the futures contract, right? This final settlement takes place on the final day, and we will not go into much more details of this final settlement process, but I'm just going to take you towards another important thing that I wanted to discuss before we end this lecture, and that is, let me share it once again. Yes, yeah. Uh, Yes, I wanted to share some details about the physical settlement. The physical settlement. The physical settlement of the commodities involves the following three entities. Number one, accredited warehouse, registrar and transfer agent, and an assayer. Now, I want to tell you. Initially when we started this subject, I think gave you a brief introduction that how these warehouses are playing such an important role in the futures market, in the commodity markets. Okay, the establishment of these warehouses, actually, see, it depends upon the kind of the country you are into, that how much development has happened when it comes to the warehouses. It is the emerging markets do not have a very good infrastructure when it comes to warehousing and storage capacities, and if they, even if they have, the conditions are not very good. Okay, so goods, once a good infrastructure, good condition of the warehouses are not available, then what happens is that the goods which are there waiting to be sold, right? Those goods, if you want to take up any kind of the financing facility based on those goods, it will be difficult to get. Okay, because the goods are not in a safe condition. So with the advent of time, these kind of the warehouses started developing in India, and good infrastructure was started becoming a part of Indian business, and this helped Indian businesses to take up certain, financing line of credit against the security of the goods which are actually placed in these warehouses. Either it is the final goods that you have produced, or it is the raw material. It is actually one warehouse financing has come up in the past couple of years. This financing is a very good method of finance, getting a line of credit based upon the goods which are there in your warehouse, right? So you every time see you have some or some amount of inventory is there in your business, right? We cannot be as advanced as right now. We can be, but we are not as advanced as Japan, that we can actually work with a system which is known as the just in time inventory. So what happens in the just in time inventory, we actually call for the inventory or the raw material, whatever, in our warehouse, in our manufacturing facility, just 1 hour, let's say, before actual manufacturing starts. So yeah, I mean, this actually makes it difficult for us to reduce our working capital expenditures, because if we cannot reduce the time, we actually have to call it few days before that. Few days before we actually need it in our manufacturing facility, we need to call that raw material in our facility, right? And if we have to keep it there for few days, either it is your raw material or it is your finished goods before actually they are sold to the consumers, we will have to take care of it, and that is actually lying in my inventory expenditures, right? In my balance sheet, my inventory keeps on exceeding. It means my investment in my current assets keeps on increasing. So that's why inventory is one of the current assets. So if my current asset investment has increased, it means that my working capital expenditure has increased. Okay, so if we have this, if we cannot reduce our inventory, but if we have some method of getting a financing based on our inventory, it is still a positive thing. So yes, we have now the accredited warehouses available, and these warehouses actually can help us to get the line of credit. So these are one of the very important entities involved in the physical settlement. The commodity exchange specifies the accredited warehouse through which delivery of a specific commodity can be affected, and which will facilitate for storage of the commodities. For the services provided by them, warehouses charge a fee, right? Sometimes some what happens is that some business houses are have so much expanded operations that they have their own warehouses, and in many cases these warehouses are actually different entities, and this particular thing has been outsourced to these. We take it on rent and we pay them, and they maintain that for us, right? So these are the accredited, they are the accredited ones. I mean, they should be accredited by some kind of agency, and only then the insurance is also there. The storage facility has to be very good, and once they are accredited, you can actually go and get your financing facility based upon the material. So you can hypothecate that material, that goods or which are there in that warehouse, and you can, based upon that hypothecation, you can take some kind of the line of credit, right? Now, storing the commodities, point number three, storing of the commodities in line with the grade specifications and validity period, and facilitates maintenance of the identity. On expiry of such validity period of the grade of such commodities, the warehouse has to segregate such commodities and store them in a separate area. So there are rules and regulations, and according to the grade of the goods, they have to be, maintained. They have to be stored. Approved registrar and transfer agent. We also call it R&T agents. Now, the exchange, the commodity exchange specifies approved R&T agents through whom the commodities can be dematerialized, and who facilitate the dematerialized or the rematerialized of the commodities, right? In a manner prescribed by the exchange. Now, establishes this particular perform different functions. We will not go into very much detail of that, but yeah, having an R&T approved R&T agent is also one of the very important part, right? Then we have Yeah. So what are then we have the SAR, another, not very common, but yeah, exchange specifies approved SARs through whom grading of the commodities, right, received at the approved warehouses can be availed by the constituents of clearing members. And this is particularly important in the case of agri commodities because the grading of these commodities, what is the level of the grade of these different commodities, be it rice, there are different grades of rice. When we talk about the wheat, there are different grades. So there has to be some approving authority which decides that when the commodity has come to my warehouse, this is the grade of that. And later on, when this settlement takes place, nobody can claim, right? And everybody is clear about the grade. So that's why all these approvals are being done by the SAR, right? So, yeah. So what are the different instruments available for trading? We people have already covered up this thing in very much detail in the last lecture. That these are the instruments. We have the forward contracts, we have future contracts, and we have the options, right? We have already covered up that the trade on what is the basic difference between the forwards and futures? They're very much similar to each other. ठीक है, they are very much different. Both of them are different from options in one, way that one particular point which differentiates forwards and futures from the options is that we cannot limit our loss in forwards and futures, but we can do it in options. And there is no fixed charge in forwards and futures. You just have to enter the contract, and it is executed at a future date. But in the case of options, yes, we have to make a payment, upfront payment of some kind of the margin money, right? So, but what is the difference between forwards and future? So the trade is on an organized exchange, and forward is the OTC in nature. So risk is comparatively more in forwards. Moreover, it is more futures market is more liquid because again it is there on an organized exchange, right? You don't have to find the buyers and sellers, but yeah, there is a less liquidity in the case of the forwards. Standardized contract terms are there, but let's suppose you want to enter into a contract, futures contract in the rice. So they will be having, let's say, standards. Either they will be having 3, 6, right, 9. There's no in between 3 and 6 months, right? So you can't make it according to your requirement. But in the case of the forward contract, the contracts are customized contract because there is no exchange involved in this. Right, so futures required the margin payments, but there is no margin payment in the forwards again because it is a very flexible in nature. It follows the futures follow daily settlement, but in the forward, what happens? There is a full and final settlement which actually takes place at the end of the period, right? So, yeah, just giving you a glimpse of the options just for one last time, and then we will wind up this lecture, right? Yeah. So in options, what we covered was there are two types of. So in options, what happens that you have an option that you really want to, holder does have a right to exercise or not exercise this particular trade at the end of the maturity period. And there are two basic types of the options: call option and the put option, right? Call option gives the holder the right to holder the right but not the obligation to buy an asset at a future date. And in the case of put option, you have the right but not the obligation to sell a particular asset at a future date. So you have to take different positions. You can be a buyer of the call option, you can be a seller of the call option. Again, you can be a buyer of the put option and seller of the put option. Based upon your option and the position that you have taken on your option, you have various positions that you can take place and the various kinds of the graphs that we already covered up in this case. So as I told you, buyer of an option, either put or call, and then we have the writer of an option, means the seller is called the writer of an option, either a put or a call option. Right now, this writer of the option receives the option premium, which is actually the price, that the fixed price you have to make to pay in the option, because this gives you a flexibility of not executing your contract at the end, and that needs something to be paid, and that's been borne, the cost is being borne by the buyer of the option and being paid by the writer of the option, right? So that's called this. And there are certain prices we have done. We have, I think we have not done the American options and European options. We have actually, yes. So American options are the options that can be exercised at any time, right? But so we have a maturity date, and you can exercise those options any time before the till the maturity or expiration date comes. And then European options are options that can be exercised only on the expiration date itself, right? So all these points being covered up, and uh, let's continue this topic let's continue this topic. All these hedging speculations has been done already. If required, I will give you examples of all this speculation hedging. I think already been done. Yes. So we will be continuing with our next topic of discussion in the upcoming week. Most probably this topic will be. Yeah, we'll be now talking about agricultural commodity markets, right? Analysis of the agricultural commodity market, commodities and instruments available for trading, right? So we'll be taking this topic in the next upcoming week, and we can also, I think, take the risk management in commodity markets, right? How actually the risk is being managed. One of the main reasons why we actually want to enter the commodity markets or derivatives of the agri commodities is the risk management. So we will talk about these two things in the upcoming weeks, and I think we are good. Uh, we have covered up enough for today, and thank you very much. If you have any doubts, you can always reach out to me, and I'll be sharing this material with you very soon. And I'll share some extra material for your practice as well, so you can practice more numericals for that. Right. So thank you very much for your patient listening, and let's meet next Saturday. Till then, have a good time.